This chart shows a scenario most retail traders know too well. You spot a perfect technical breakout, enter a buy position, and instantly the price reverses and violently crashes your account into the red. Large institutional players, banks and hedge funds, control the vast majority of market volume. In these scenarios, they systematically use retail buy orders as the necessary liquidity to fill their own large-scale sell positions. Because their orders are so colossal, these institutions cannot simply click buy all at once without causing the price to spike prematurely. To accumulate a large position, they are forced to engineer traps that trigger retail sell orders, providing the volume they need to enter the market. Over a century ago, Richard D. Wyckoff documented the recurring structural patterns left behind by these large operators, creating a system for tracking their movements through raw ticker tape data. Today, Wyckoff's method acts as a forensic X-ray for modern Forex trading. It allows you to look past the noisy surface of the market and see the quiet phases of accumulation and distribution that institutions are running in the background. Mastering this system shifts your perspective. You stop providing the liquidity for institutional traps and start timing your entries to match the actual architects of price action. To track smart money, we first have to recognize that markets operate within a chronological cycle governed by the law of cause and effect. A price trend is the effect, and the preparation phase before it is the cause. The macro cycle flows through accumulation, markup, distribution, and markdown. In accumulation, institutions quietly build their cause. Price oscillates sideways between support and resistance. Smart money absorbs sell orders, buying downward spikes to contain price action and avoid alerting the public. This sideways price action represents a highly orchestrated loading zone where massive institutional capital is systematically deployed into the market before the next trend begins. In the late stages of accumulation, the institutions need to finish filling their massive orders and test the market. This leads to the ultimate smart money trap, an event known as the spring. Watch the price action closely. Institutions push the price just below the established support line. This triggers the stop losses of early buyers and tricks retail breakout traders into shorting the market. Then the price sharply snaps back into the safety of the range. But Forex is a decentralized market without a central exchange. Without centralized data, how can you prove this dip is an institutional spring and not simply the start of a genuine market crash? Tick volume measures price changes per bar, revealing institutional activity. This demonstrates Wyckoff's law of effort versus result. If a massive volume spike occurs exactly when price dips below support, but price fails to stay down, it proves institutions are absorbing the retail selling panic. This same logic applies to the top of the cycle. During distribution, an upthrust after distribution pushes the price briefly above resistance to catch euphoric retail buyers before a reversal. High volume spikes at these false breakouts suggest that smart money has finished absorbing liquidity and is preparing to reverse the trend. Identifying the cycle is only the first step. To capitalize on these moves, we need to pinpoint a high probability entry point. Professional traders do this through confluence, the strategy of layering micro-scale Wyckoff patterns directly on top of traditional, higher timeframe technical analysis tools. This 3D view illustrates the ideal setup. Aligning a broad daily support zone with a micro-scale Wyckoff spring creates a point of high conviction confluence. The daily chart provides the structural floor, while the 4-hour chart reveals the specific institutional footprint required for an entry. Your entry trigger occurs just after the spring. Wait for the price to reclaim the support level, an area known as the last point of support. A confirming candlestick pattern here, like a bullish pin bar, demonstrates that buyers have officially rejected lower prices. Risk management is mandatory. Your stop loss must be placed just below the absolute low of the spring. If the price falls past that line, the accumulation theory is invalidated, and you must exit the trade. Wyckoff's law of cause and effect helps determine profit targets based on the duration of the range. A phase of accumulation that lasts for months absorbs a greater volume of supply, building a larger cause that typically fuels a more sustained markup as the effect. Using this framework transforms your approach to the charts. You move from reacting to price fluctuations to reading the institutional narrative hidden within the data. To practice reading the smart money footprint for yourself, open an FXNX demo account today. You can test these strategies with zero risk using institutional-grade 0.0 pip spreads and lightning-fast execution.